Who would make the choice to start a capital markets business in 2010, one of the worst financial crises we've seen in our lifetime? Today on Stories Behind the Door, we talk to co-founder of Talonvest, Tom Sherlock. So excited for today. It's Legends Week on the Stories Behind the Door podcast, and we're going to hop right into it soon with my guest today. I'm Thad Campbell, host of Stories Behind the Door, Director of Business Development and Strategic Branding at S3 Partners. We've got 30 years, over 300 ground-up developments under our belt. Want to give a shout-out, as always, to our sponsor, Kiwi 2 Construction. Wayne Woolsey and his team have been providing steel structures in the self-storage and small bay industrial flex space for more than 30 years. If you have any needs, you can reach out to them at kiwiconstruction.com. All right, I'm so excited today to welcome one of the co-founders of Talonvest, Tom Sherlock. I've gotten a chance to listen to you a bunch of times, finally got a chance to meet you at the investment forum back in January. First and foremost, want to thank you for taking time out of your schedule to come and join me.
I appreciate being here. And Legends Week, I know Ken, yes, Tom, not so much, but I'm glad to be here. Thank you.
Listen, you definitely qualify in that group. I talked to a whole lot of people in storage, and the level of respect, it maybe not quite the level of respect Ken Woolley gets. I don't know if anyone quite gets that, but you certainly are well respected in the industry. And so very excited to dive into that. I'll start this podcast always the same way. Storage, such a niche asset, something I've been so blessed to find myself in late in my working career. How did you get involved in self-storage?
I got into it later in my career, just like you. And my entry into the sector really is connected to the founding of Talonvest and our predecessor firm. Eric Snyder and I founded this company back in 2010. And our predecessor firm, we had an investment management platform and a mortgage banking firm. And I was one of the senior executives of the firm at one point, 85 people, 5 offices across the country. Eric Snyder and Jim Davies ran a self-storage unit inside that company. And so in 2010, when Eric and I started Talonvest, I had sort of the institutional relationships and background. Eric had the self-storage connections and background. And then Jim Davies joined us about a year later. And in 2012, late 2011, 2012, we made a bet as a company at Talonvest. We believed that the self-storage sector was really going to become institutionalized. It wasn't going to be the niche asset that it had been for so long, and kind of, in some ways, the redheaded stepchild that was the most successful of all the children. But we made a bet on self-storage growing and becoming institutional, and we could parlay some of my relationships with Jim and Eric's relationships with the owner-operators. It worked out well for us. It's good to be lucky, but it worked out well. And that was really my entree into self-storage. And I got to tell you, over 15 years, and I've worked in many of the other sectors, storage is special. The people in this industry are just, they're as good as it gets. It's so much fun to be operating in this sector. So I love it.
I talk about that frequently on this podcast. There's a couple questions I want to ask you, and I'm trying to just note them in my head, but we'll go down this road because you brought it up. I was 48 when I got into storage, and like you, had many different careers before I got in here. My first was working at a TV station, which is about the opposite of self-storage as you could possibly get. I want to talk about this because the people in this industry, almost to a person, are so kind and treat each other with so much respect. Even me, when I knew nothing, I didn't know what a cap rate was. I didn't know what IRR meant. I knew nothing about this industry, and people treated me so kindly. What do you think it is about self-storage that lends itself to that kind of kindness?
That it's a great observation that you made, because my experience was different but similar. I had a whole lot of institutional background and technical knowledge, but I didn't have the storage relationships and the welcoming factor from all of these folks. You know, whether they're the founders of large private owner operators like the Metro guys or William Warren Group guys, or or the public folks. I mean, just so incredibly welcoming. Why they're like that, I wish I had a good answer. I don't know if it's just the camaraderie of having been kind of flying under the radar for so long, and the sheer smaller number of people who are active in the industry allowed those relationships to get built early. And, and kudos to some of those early pioneers in the sector for really creating things like the Self-Storage Association and bringing people together to share knowledge and share information. And I think they grew together, and it was a wonderful thing. And they kept that mentality of being open and receptive to new things and new people.
100% that there's some folks early on that deserve kudos for that, and thankful that it's continued for 50 years and hasn't shown any big signs of changing recently, which is great. Hopefully that stays. I want to go back to what you said earlier, although you just opened up a third question that I want to ask you now. So we're going to go back to number one question, which is 2010. Not exactly the time in the world where people think, hey, let me go start a business trying to find debt and capital for people. Why 2010 did you guys decide to take this leap?
You're not the first person that questioned my sanity around the 2010 start of a new entrepreneurial firm. But it's interesting because I've been in the real estate finance business since 1985. So in early parts of my career, I experienced the RTC crisis and lived through that and prospered through that and saw how opportunities come inside those disruptions. I'll call it a disruption. And in the early 2000s, late 99, early 2000s, we saw things that had happened and rattled the industries, the markets, some, not the industry, but the markets. And those corrected quickly. Fast forward, great financial crisis, 2007. From 2010, we start Talonvest. It was just time for me and for Eric, with where we were with our prior firm. We left on a very amicable terms, and my partners there are still some of my good friends, and one of my mentors was the CEO of the firm. Great relationship, but it just was time. We had run our course, and Eric and I really wanted to, in 2010, come back to the roots of that prior firm and really focus 100% on the client and representing him in the best way we possibly could. And we had the prior firm had sold an interest to a large money management firm, so they had changed the dynamics a little bit. You brought up the reality. It's the great financial crisis. The first year, boy, you talk about hard. We have the incredible challenges of really a frozen capital markets. It's one thing when it's a hard market like today. It's another thing when capital is frozen. That kind of disruption is pretty catastrophic. The need for advice and counsel is very, very high. The ability to execute is very limited. And the first year was painful. But come 2011, that's when things started to pick up and roll for us. And some of that was obviously because self-storage did better than other sectors. But I guess we're believers in
giving me more questions to ask. You keep saying things and it keeps giving me more questions. I want to dig into this a little bit. Where did the courage come from, man? Because you're right. 2010, I mean, you're talking 2 years into frozen capital, and you guys have the guts to go out and go on your own. What about the first 25 years and doing what you were doing gave you the confidence to take that leap?
Yeah. I'm not sure. Some people might describe it less as confidence and more lack of intelligence. I know I had family members that question that sometimes. For me, speaking just for me, and Eric could have a different answer relative to this, but for me, I'm a believer that cycles happen, but good industries survive. And commercial real estate broadly is a good industry. Self-storage specifically is a great industry, but we were very active in multifamily and industrial prior in my past. And so add on self-storage, you got three great industries, and they're going to come out of it. And sometimes in the difficult times like 2010, you have the opportunity to build relationships, gain credibility, gain trust, show that you have experience and knowledge, and that you care about outcome when it comes to brokerage, debt or equity. In our case, when you care about the outcome for the client more than, hey, there's a deal, grab it and let's close it and put our hand out for a fee. It's about the relationship and saying, are we helping somebody structure capital right? Is this going to be a long-term good answer? And sometimes we have conversations with clients and they tell us they want one thing, and they're the client. They get to dictate that, so to speak. But there's times we're having conversations and saying, are you sure? What about other options. We should think about these things. And so 2010 in a lot of ways was an ideal time, as long as you could survive the first 18 months.
You brought up something that's fascinating to me and maybe is applicable today, maybe not. From my side of the table, looking at what's going on, it's hard to believe that there isn't going to be some distress for folks that either bought assets or build assets 2020, 21, 22. Obviously, you're dealing directly with those operators. How do you have those conversations? And you can fill in the gaps if that's a reality of what you're going through today. Certainly in 2010, 2011 was the reality. How do you stay calm in those conversations when you're talking to a client who's in a pressure filled situation?
Uh, my wife likes to describe me as the world's first living heart donor, and my wife has a medical background, and thankfully she's joking because we've been married a long, long time. But she says that because I don't react to a lot of things, good or bad. I kind of ride that middle wave. So when some of the turmoil is happening, it's sort of my nature to not get too up, too down.
One
Look,
of my first real estate mentors always told me, don't get on the roller coaster, stay on the platform, and something that always stuck with me.
Exactly, and I learned something from a mentor who was a professor, not one of mine, but from a program I helped create for another organization, a leadership development training program. Gentleman who was UCLA professor who just had a simple mantra: it's not necessary to react. And I had lots of conversations with him about that. I used to have that stuck on a little yellow sticky on my computer screen all the time. It's not necessary to react. And underneath it, I wrote, but if it'll help, do it. Because sometimes there's some value in it, but most of the time there's not. So the staying calm, not reacting is not challenging for me. But in today's environment, because what you talked about, 2021, you were at the NYSSA investment forum. You saw the panel I moderated. I know you described it as there was a negative sentiment there and a lot of people have said that we haven't felt in the industry in a long time. Mm-hmm. I think I have described it as a reality check. I think there was honest perspectives that were shared. And the good thing is, almost everybody, if not everybody, is optimistic about the future, which is really important. But recognizing the reality of today, there are some challenges. There are deals that were capitalized 3 years ago, value add acquisitions, development deals, and they were capitalized based on what the environment was then. And somebody who was willing to take more risk that at that time now is feeling the pain because they went out on the risk curve 3 years ago, and now they're facing the reality of higher interest rates, not difficult getting occupancy, difficult getting rents.
Yeah, 100%, right?
And so that's the challenge. That's the hard that we're facing today with disciplined lenders after they've gone through some challenges in other sectors where they start to say, hey, I may love storage, but I got to be really thoughtful about this.
So I go to the investment forum, right? First full week of January. Coming out of that, Kiwi 2 Construction gets bought out by Janus for almost $100 million. Obviously, SmartStop absorbed the Argus management platform. Now we see, and I'm blown away by this in the context of what you just talked about, right? 2021, StorageMart buys Manhattan Mini Storage, under a 4 cap, I think that deal traded at. I'm thinking in the back of my mind, and I talk to the Burnhams pretty regularly, and they're not, they've never been overly distressed about it. But on the flip side, like I'm looking at what's happening to rates in the New York City market. I know the cap rate they bought that at. They go and buy another $1 billion portfolio in New York City, which kind of takes away the idea that maybe they were upset about that first purchase. You may not want to comment on that deal specifically, but from a macro level, that sends a statement about where self-storage is, I think. Tell me if I'm wrong.
I agree with you. It does send a statement, and the way I see things right now inside the sector, there's a component of it that is the haves and the have-nots. And there are markets like where the Burnhams are in New York, Manhattan, that's a have. That's a have market. And I think it's okay and prudent even to be making acquisitions at more aggressive cap rates when you have a capital structure and a balance sheet that allows you the time that it might take to realize a lot of value. So I think the Burnhams are smart, sophisticated folks, and I think you described it very well, and it is a statement. Then there's other markets where there is some overbuilding, where there's some levels of, dare I say, distress. Stress
Yeah,
is what I'll still call it, but we might hit some distress in some markets. We might.
fascinated to follow up something you said about the haves and the have-nots, right? When I first got into this industry, it was August of 2021, so really not that long ago, but it was literally the peak of the bubble, right? It was there was as much gung-ho as you could possibly get. Had just come out of the Tennessee SSA, which was like the first live event that everyone had gone to. I can't imagine there being any more excitement about an industry than what storage was going through at that moment. But the thing I kept hearing at the time is this is a mom and pop industry. This is a mom and a pop industry. 15% of the assets are owned by larger folks. There's still 80+% mom and pop. Fast forward to 2026, and if you really look at institutional grade facilities, 50,000 square feet and up, it's more like 80% REITs and big private equity groups than it is mom and pops, right?
Yes.
I want to ask you, is it possible for someone who's smaller these days to get into storage and grow a portfolio that's going to reach any level of significance?
I think there is. I do think that opportunity exists. I think it has to be done in a different way than it would have been done in the past, because that segmentation, like you described it, that's the reality right now. So I think somebody who wants to, on a private level, grow a real portfolio has to be willing to underwrite and understand the risks associated with maybe secondary and or tertiary markets, figure out a way to be able to realize effective management and data analytics inside that kind of portfolio. That's not easy to do, but I do think that the opportunity exists right now. I know there's some folks that are trying to capitalize on that. The writing, we'll see if it comes to fruition, but I believe there's the opportunity to make that happen. It just will be done a little bit of a different way than it was done before. And I think so many times it's a little bit of where the naysayers are. If somebody spends a little time really to think it through, they can find the opportunity. So.
I love that you said that there's still some opportunity out there for folks to get in. This begs a question, which is technology has become such a major talking point in the world, but specifically in self-storage, which a lot of people say is maybe a little bit behind the curve in adopting. How do you see this? And obviously you've been around for a while and gotten to see technology grow in a way that most people haven't. I'm on that same boat. I didn't see a website till I was in graduate school. How is it playing a role in self-storage, and how do you see that impacting what we see going forward?
It's funny because you bring this up. A number of years ago, I was having coffee with Patrick Riley, urban self-storage out in the Pacific Northwest, and he's a former Microsoft executive. Patrick said to me over coffee, this was early, this was around 2011, something like that. And Patrick said, I'm not sure if self-storage is the easiest, most complex business in the world, or is the most complicated, easy business in the world, but it is one of those two things. And he came from that technology background, and he was really in the forefront of I think, innovating into technology, into the sector. It's reality now. The real estate industry as a whole, in my opinion, has always been just slow to adopt technology. It's got that dinosaur sort of mentality about it. And even our sector in the finance brokerage side of the world, we've spent over the last 18 months an enormous amount of time and effort trying to integrate technology inside our firm so we can utilize it. And we have been able to, we have been able to not just say AI and wow, isn't that great, but actually be utilizing it in how we're accessing the market, and where we may have been able to access 1,000 lenders before. And that's probably a pretty reasonable number from a couple of years ago. Today, we can access 7,000 lenders with information.
Yeah.
When's the last time they did a deal? How was it structured? What were the property types? Where were they? So we can use technology to really increase the potential options for capital in any given transaction. The key still comes down to, in our business, it's just like a lot of real estate businesses, relationship business. So when we get down to those, great, now we have access to so many more lenders. But when we narrow it down and we're trying to solve a capital stack problem or structure or question for a client, and we get down to the last couple, 3, 4 lenders, whatever it is, relationship matters. And so I love this time because we're getting new with technology. We're getting to reinvent some things. And then we have the tried and true old reliance on relationship that still matters a lot. It's fun.
Couldn't agree with you more. It's making something I feel like is my strong suit, which is building relationships with people, is becoming more valuable, right? Because we can replace some of the other stuff with technology, but that ability to go out and make a relationship with someone is still important at the end of the day. I want to pivot a little bit. You brought up the RTC, going back to the 89-90, the savings and loan crisis. I was born right at the tail end of the gas crisis in the early 70s, financial crisis 2008. That's about every 18 years, right? And we're now 2026. So you're obviously dealing constantly with banks and with people that are needing capital. What are you seeing in the financial markets overall? Are we in a place where we're going to come out of a quote unquote recession, a challenging time? Are we potentially looking at something that's more troubling than what we've been through? I'd love to get your take on this.
Hope I'm right with this opinion, because that's all it is an opinion based on some experiences. I think on the capital side of the equation, we're coming out of the bottom, and the capital may be ahead of the real estate right now. Capital had to, and if I look at the different segments, life insurance companies, CMBS, debt funds / private lenders, and banks. Debt funds and private lenders had a great resurgence because of some of the troubles banks were going through several years ago. And they have not had difficulty raising capital. And so there's a lot of capital in that segment. Meanwhile, the banks who were having problems several years ago have cleaned up their balance sheets. And so a year ago, I was actually at a panel here locally in Southern California with one banker who I know really well, who runs the Western region for a large bank, and 3 developers. And the banker was the most optimistic guy on the panel, and it became the running joke. And this was now 15 months ago. Here's the banker being the one, and he was saying how we licked our wounds, we cleaned up the balance sheet, we are flush with cash, we are ready to lend money. Life companies haven't gone away, they have fresh allocations, they're hungry. CMBS just had a really successful year last year, and they're expecting another one. So capital is not a problem right now. Availability of capital is not a problem. Risk underwriting is where the discipline comes in, and I know that is frustrating for borrowers at times, because they want the aggressiveness that existed in the prior cycle. But in reality, lenders' discipline elongates the health of the next cycle. And so I sit back from my seat and go, I think we're actually going into a really good time. It's going to take a little bit of time to get there operationally for storage and some other property type, but capital, I think we're in a pretty good spot.
I think this has been a fascinating thing for me over the last months coming out of the investment forum, is just the constant thing I'm hearing is capital wants to get in, capital wants to get in, capital wants to get in. It's not always easy to find a deal that works for that capital, but I'd like to pick your brain on this because we've now seen a prolonged period of time where things are trading for cap rates that represent pretty significant negative leverage on what typical debt would be. How long can that continue? And do we see that is the abundance of capital that's trying to get into storage what's causing that? Or do people have access to capital that is at a lower rate than what the rest of us are dealing with?
I think there's some groups that have access to capital that most of us don't, and it's lower priced, and they can tolerate and function inside a lower cap rate environment economically better than most of us. I think that's part of the equation. Another part of the equation right now is negative leverage gets a white hot spotlight right now. Negative leverage has existed for a long, long time. When you talk about a value add play, when you talk about a development deal, well, That's negative leverage. But there's a real fundamental belief that it's for a finite period of time and we can come out of it. We haven't had the ability to come out of those negative leverage situations right now. That's some of the cleansing that I really do think has to happen for the benefit of the sector. It's pain, and I know it's pain, and I don't like to talk about it that way, but there are deals that were capitalized 3 plus or minus years ago that were over levered. And I don't think there's a magic elixir out there that's going to solve both their rent issue, supply issue that may exist in their market, and the reality of where the interest rate environment is today. Interest rates move in a cyclical environment. Howard Marks talks a lot about that from Oak Tree Capital. I think he's a brilliant guy, and I believe similarly to him, we're just in a different part of a longer interest rate environment cycle. And I think we're going to have these kind of rates for longer, even though we're going to have a new Fed chairman coming in, and we might have lower short-term rates. It doesn't mean the Treasury is going to go down with it. In fact, I don't think it will.
I agree with you wholeheartedly. My fear is the exact opposite, that if they keep cutting the overnight rate, that we might see the 10-year go the opposite direction. So I'm hoping that there's some sanity there. That's as much as I'm going to interject. A question that I wanted to ask you, and as we're finishing up, going back to the beginning, you talked about making a bet on storage in 2011. What did you see in 2011 that you and Eric together decided that this was the asset class to bet on?
Yeah. Well, when we made that bet, Jim was with us too. Unfortunately, he passed
Give Jim some
years ago,
yeah.
but he was such an icon in the industry. But the three of us, what we saw was a tremendously successful sector inside commercial real estate that had this unique combination of consistently high returns with consistently low risk. Low risk being defined about default rates and things like that, an easy public way to be able to measure it. And not enough investment options in the institutional world. It used to be commercial real estate was an alternative asset. In the early 2000s, when we were raising money at our predecessor firm and with institutional investors, we were commercial real estate. We were an alternative investment. Okay, well, then it becomes sort of a mainstream asset class. But of course, then it's office, industrial, multifamily, and retail. And once one of those sectors would have an issue just because of a cycle, now there's a lot of capital sitting around going, where do I go? Where do I go? How do I stay in real estate? And so that started opening up the interest level, and self-storage was one of the first ones that really had that interest level. So because of our relationships, we had a view into that. And we really believed in the sector. And like I said, we made a bet. We went from 50% of our business being commercial and 50% storage to being 90% storage and 10%. And it wasn't because the commercial was going away. It's because storage was growing that rapidly. And today we're not pivoting away from storage, but we brought somebody in the hospitality sector. We do more in small bay. I know you do. You have a small bay interest and background.
We'll talk. For sure. Listen, you got your Nostradamus hat on. Clearly, you have a little bit of foresight. Anything that I should know about coming up that I should place a bet on?
I wish I was that good. Maybe on the Super Bowl Sunday, but
I'm from New England, so I'm hoping that the underdog prevails. Although I have to say I've had enough Super Bowls in my life, so I'm not going to get too greedy. Tom Sherlock, cannot thank you enough for taking the time and so insightful and so much amazing knowledge that you were willing to share with me. I really appreciate you taking the time. It's been an absolute pleasure.
It's been an honor being on here with you, Thad. Thank you so much for inviting me. It's been a joy.
I'd be remiss if I didn't mention, you can see Tom's email down on the bottom. Somebody that wants to get a hold of Talonvest, what is it that makes a client for you guys that you think you can help, and how do they go about getting a hold of you guys?
Our clients tend to be more experienced, a little more sophisticated, often have institutional investment partners, but they have a sizable portfolio. We tend to be able to bring more value to clients when we're talking about 10 to $500 million financings with a sweet spot in that $20, $25 million range. In storage, lots of portfolios that we're doing. So it's fun stuff. We'd love to help anybody.
Cannot recommend you guys enough. Obviously, just got to know you this year, but Anna Sarazi Herdina, who's on your team, I've been such close friends with her for a long time. Not just because we're both from Rhode Island, but we'll leave that for another day. Tom, thank you so much. Looking forward to hopefully having you on again sometime in the future, and cannot thank you enough. I would be remiss if I didn't say, for somebody who's been a part of this industry for as long as you have, thank you so much for helping to create, what is, as you said, very unique. The environment in this is something that I cherish and I hope stays the way it has been for many, many years to come.
Your words to God's ears, man. I love it.
Want to give one more shout out to my friends at Kiwi 2 Construction, Wayne Woolsey and his team. I'm literally looking out my window at a 3-story they're building right now in the middle of freezing temperatures, in the middle of the worst winter we've had in New Jersey in forever. Those guys are on site early, getting the job done. So if you have any needs for steel structures, reach out to them at kiwiconstruction.com. And thank you so much for the support of the Stories Behind the Door podcast. That's it for this week's episode. He's Tom Sherlock, co-founder of Talonvest. I'm Thaddeus Campbell, Director of Business Development at S3. We'll see you guys next week.